Ever wondered how a Bitcoin ETF works? Well, let's dive right into the world of cryptocurrencies and exchange-traded funds. Bitcoin ETF, short for Bitcoin Exchange Traded Fund, is an investment vehicle that closely follows the price of Bitcoin. It's a bridge of sorts connecting the traditional finance world with the somewhat uncharted territory of digital currencies. Now, here's the fun part. A Bitcoin ETF allows you to get a piece of the Bitcoin action without having to own the digital currency directly. Think of it as a mirror reflecting the performance of Bitcoin while allowing you to stay on the sidelines. This way, you're not dealing with the complexities and security issues of owning and storing the actual digital asset. In essence, Bitcoin ETFs bring the high-octane world of cryptocurrencies to the broader market, in an accessible and regulated format. So, you might be wondering, how does this Bitcoin ETF actually work? To understand how a Bitcoin ETF works, we first need to understand ETFs. An ETF, or exchange-traded fund, is a type of security that tracks an index, sector, commodity, or other asset. It operates much like a mutual fund but is traded on an exchange like an ordinary stock. This means you can buy and sell shares of an ETF during the trading day at fluctuating prices, just like you would with individual stocks. But how does this relate to Bitcoin, you may ask? Well, a Bitcoin ETF is an investment fund that tracks the price of Bitcoin. Here's how it works. When you purchase shares in a Bitcoin ETF, you're not directly buying Bitcoin itself. Instead, the ETF does that on your behalf. So for every share of the ETF that investors buy, the fund purchases an equivalent amount of Bitcoin. This ensures that the price of the ETF shares is closely tied to the price of Bitcoin. The fund's managers are responsible for ensuring that the ETF's price accurately reflects the value of the Bitcoin it owns. They do this by frequently buying and selling Bitcoin to match the supply and demand for the ETF shares. So why would someone choose to invest in a Bitcoin ETF instead of buying Bitcoin directly? Well, there are a few advantages. First, it can be a more convenient and accessible way to invest in Bitcoin, especially for those who are unfamiliar with or hesitant about the process of buying and storing digital currency. Second, it offers a way to invest in Bitcoin within a traditional brokerage or retirement account. Lastly, it can offer a layer of protection, as the ETF is managed by professional fund managers. However, it's important to note that investing in a Bitcoin ETF is not without risks. Just like with any investment, the value of a Bitcoin ETF can go up or down, and there's no guarantee of returns. So, in simple terms, a Bitcoin ETF is a way for you to invest in Bitcoin without actually buying and storing the digital currency yourself. So what does this all mean for you as an investor? Well, let's break it down. Bitcoin ETFs essentially simplify the process of investing in the world of cryptocurrencies. You no longer need to worry about purchasing and securely storing digital currencies directly. Instead, you can gain exposure to Bitcoin through these ETFs, which function much like regular stocks. This means that you can buy and sell shares of a Bitcoin ETF on traditional stock exchanges, just as you would with shares of a company. It's a game changer for those who are familiar with traditional investing, but might feel daunted by the more technical aspects of dealing with cryptocurrencies directly. So, the beauty of Bitcoin ETFs is that they bridge the gap between the innovative realm of cryptocurrencies and the familiar territory of traditional finance. In essence, a Bitcoin ETF brings the world of cryptocurrency into the traditional financial system, making it easier for everyone to get involved.